The Draghi speech-inspired rally in equities that we've seen over the course of the last couple of weeks continued during the course of last week, albeit the gains were more modest. Slight signs possibly of the rally petering out a touch. But if we take a quick look at the chart of the FTSE 100, we can see that it has been a good June and July, rallying off those lows of about 5,300 back up again to 5,800 where we stand at the moment, and that actually means that the FTSE is up on the year by about 4%. So whilst it's been a volatile year, it is, despite everything going on, showing some modest gains at the course of this year, and possibly in time will be seen as in line with longer term trends. So as I say, heartening to see that. If we are looking at levels, clearly the market has toyed with the level of 6,000 in the past up in this region here, so all eyes as whether or not we can sort of have another attempt at 6,000 in the course of the next couple of weeks. Now, really just 2 or 3 charts to demonstrate what are the key movers at the moment. You may recall in the speech from Draghi that he was focusing his attention on the shorter dated duration bonds in the periphery countries. That's where he said classic central bank activity will be focused on. And what that's meant is that if you were to look at, say, duration of 2 years, 5 years and indeed 10 years, you've seen some quite marked differences now in terms of the yields in those different time range, and reflecting where Draghi is going to be moving his attention. So let's take a look at the 2-year Spanish paper. That crept up to almost 7%, which was totally untenable for that country to refinance itself, even on sort of quasi-overdraft facilities, up at 7%. That collapsed down to 3.5%. We have seen a bit of a bounce back here, back to 4.2%, but clearly that is an area of focus over the course of the coming weeks to make sure that that doesn't begin to spiral back up again, and that we can keep it under these sort of conditions. Ideally, we still need it back down at those levels of 2.5%. That we saw back in March before the crisis sort of blew up again, or this stage of the particular crisis. So really, further work required on the 2-year paper. 5-year paper is a similar situation for 5-year paper. It's not going to receive such benefit from any ECB action, but nevertheless it has come off the top at the moment, back down to 5.7. But if we take a look at the 10-year paper, you can see that really, despite that little sort of spike up here, this is the area that Draghi was speaking about. It hasn't come off a lot, and indeed we are creeping back up at the moment. And I think what this is telling you is that any action that the ECB are looking at is really designed to try and sort of continue supplying support to the 2-year end, and that hopefully is going to buy time, sufficient time, for these countries to continue to engineering their austerity plans and moving their economy hopefully back on track. So that's the picture in terms of the European markets. It's a backdrop, as I say, that is in promoting a little bit more risk coming into riskier assets such as equities. If we take a look at the UK, it was an interesting week for the UK last week. We had the inflation report from the Bank of England really painting a gloomy outlook, albeit I would say that many of their forecasts are now bringing them in line with where many economists already are. So looking for growth this year of 0% growth for 2012. In fairness, that's still possibly quite an optimistic challenge, because if we would take on board what happened in the first quarter and the second quarter, by implying that we're going to come through the year with flat growth, suggests that we're going to see some growth in the second half, and as I say, that as yet is certainly not a taken. So possibly that there's still room for further disappointment on that front. But sterling, this is the chart, sterling dollar sort of held on to its sort of recent trends, so a lot of this already priced in. So I think the broad conclusion from that is that what the Bank of England was saying last week is no surprise to financial markets. If we take a look at some equities, Standard Chartered were a feature last week. We obviously saw the New York regulator, it's a small regulator, coming out and saying making some pretty big claims against Standard & Chartered, which have been refuted. The talk as we speak is that they're going to try and go for an early settlement, and that meeting will take place sooner rather than later, and that has engineered a bounce back in the shares. I suspect that going into this crisis, Standard & Chartered being on a 10 to 15% premium to HSBC, it's fair to say that premium is unwarranted at this stage, just purely because of the fact that this type of activity was taking place within Standard & Chartered. It may just bring into question the quality of their earnings stream, so whether they get over this hurdle in quick order, I suspect that premium rating has gone for the time being. In terms of a stock which is on our buy list and has featured strongly over the course of the last few months is Intercontinental Hotels Group. We've mentioned it in the context of a buy recommendation. Its shares hit an all-time high again this week, and this was on the back of encouraging results from the business. They are going to be looking to sell Park Lane. They are looking to return about $1 billion to shareholders. So it's a business that's in pretty rude health at the moment. And finally, in terms of the equity market, the Prudential I think is worth watching. We've continued to have this on our short-term buy list. Shares have just crept through that £8 level, which has proved to be a barrier in the past, and poking that through into some long-term highs at this area, but still looking encouraging. And this is really driven off of their strong growth that they're seeing out of the Far East. Just returning to soft commodities, we mentioned recently about the drought in the US and how it's now being estimated that it's costing the US around a sixth of their production in terms of wheat and corn. Just look what's happened to the pricing of these two commodities, continuing to surge. This is the corn price, which you can see has risen by over 60% really since the middle of June, and similarly this is the wheat market. So this is commodity inflation that is creeping into the system. That along with oil, which has been moving up recently, means that we just need to think about inflation maybe 2 or 3 months hence. It is a topic of conversation with the Bank of England at the moment that are talking about inflation coming out of the system. They won't want to see these soft commodity prices rising this far.